Hello, everyone. Thank you very much for joining this webinar today. Um, it's Thursday, the 7th of September, and this is the first of the after summer series of webinars that we're doing at Alpha Wealth, just in relation to helping people in areas of personal finance. And today's going to be a fairly broad one, just in terms of helping people to save money and specifically in relation to, I suppose, working towards financial independence and retiring early. I'm joined by a couple of my colleagues, Cleona O'Donoghue, who is Director of Business Development, and also Ruth Murray, who's Head of our Marketing Department, just with regards to, I suppose, taking any questions. And if anyone does have questions, please do feel free to put them into the Q&A function. We are happy to take questions during this, and we will address some of the questions we've had over the last few weeks towards the end. I will keep this strictly to 30 minutes. I appreciate that some people may be at their lunch break. And also for those of you that are listening on playback, obviously we're more than happy to take any questions you might have at any stage, and please feel free to get in touch with us. So without further ado, those of you that are not familiar with Alpha Wealth, we're a company based primarily in Cork. We do have a small presence in Dublin. There's 10 advisors. I myself have been a financial advisor for about 25 years now. We do have a lot of experience in the area of personal finance. We've just actually acquired a new business, Barrett Financial, which is a really big thing. Greg Barrett, who has just recently been announced as the president of the IRFU. So it's really nice to have that sort of accolade, and obviously it's a good signal for Alpha Wealth. So just in terms of what I'd like to cover today, basically the main focus is going to be around helping people to achieve what I call financial independence. Doesn't necessarily mean retiring. It's getting to a point where you can choose about the type of work that you do. And in order to do that, showing you how to achieve your short, medium, and long-term goals. The case studies that I'm going to use, I think, will be very, I suppose, helpful. And I find it's more practical to kind of use real life case studies. I've amended the names, of course, and the photos, but these are clients that I've dealt with over the last couple of months. And then finally, just in terms of how to claim tax back. For those of you that just joined, as I said, this is a session where please do ask as many questions through the Q&A function. Cleaner is going to be kind of managing that, and we will be addressing any queries that you might have. You can see on the screen there, hopefully, myself, Cleaner, and also one of the senior financial advisors, David Looney. David himself is doing a session next Tuesday, the 12th of September, and my colleague Ruth is going to put up into the chat the link for you to be able to access future webinars. And I would ask you to kind of keep an eye on them. They are complimentary, and we find that there are a lot of takeaways. And even on our own website, Alpha Wealth, you will find some of the previous sessions that we've done, which relate to things like child savings, how to reduce the tax you pay, and they are very relevant. So getting into the crust of it, what is financial independence? Financial independence is basically where you have an income stream that isn't through your employment that allows you to pay for any expenditures. Now, I know it sounds a little bit holistic, but really what we're saying is that you've paid off all debt, you've covered for all future expenses such as children's third level requirements, and that you can essentially live on this what we call passive income. And for most of us, really, we aim to try and get there till age 60. Some of you may have aspirations to retire earlier than that. And again, I use the word retire loosely, or indeed you may be looking to try and get to that point sometime in your 60s. And it's not about necessarily saying that you give up work. It's about being in the financial position to be able to do so. I myself, I'm turning 50 later this year, and I have a very specific kind of goal. And what we do is help our clients understand where they are now and also how they can plan more effectively for the future. And I will be covering off points like this. So to start with, one of the key takeaways from today is compartmentalization. And what I mean by that is it's really important for everyone to think about what they earn and what they spend their money on, and what you are planning for over the short, medium, and long term. And I've specifically spelled that out in this graphic of anything that relates to short-term needs. If you're looking to change a car next year, if you're looking to buy a house in the next 2 years, that would be classified as short term. And there are accounts, and we've just seen, and I'm going to touch on these in a second, announcements from the banks where they're actually starting to pay reasonably decent rates of interest to short-term savers. That wasn't available for the last 13 years. In respect of medium term, this is this kind of cohort of 3 to kind of 10, 20 years, depending on how old you are, in relation to saving for things like, children's education, for example. If you have kids in their single years, you've got a kind of a 10-year sort of time horizon and beyond. And there are more appropriate accounts for those types of savings. And then finally, what I classify as the kind of the independence years, you can call it retirement if you wish. And this tends to be for most people on the call today around kind of 10, 20 years and perhaps longer. Doesn't necessarily have to be, of course. So the key starting point is finding out what your financial objectives are. Whenever I talk to any person, I always ask them, what is it that they're trying to achieve? What are their financial goals? Is it becoming debt free? Are they looking to buy a property? Are they looking to build up a retirement fund? And help them find the right balance. And that's really the key aspect. I refer to it as kind of a roadmap where I show people specific projections for everyone on the call today. I think it's really important to understand, when are you looking to try and get to that age of independence, and what are you actually currently targeted for? So again, we'll get into more of this through various webinars that will run over the next month or so. I'm doing one specifically on the 21st of September, focused around, planning and reducing tax. But I say to people that the magic number for me in relation to getting to that point is a figure of 400,000. And what I mean by that is that if you can build up a fund of 400,000 in today's money, I personally believe that that should be enough to enable you to not have to work, certainly not to the same capacity as what most of us do. And I can go into more detail with anyone if they're interested, if you want to reach out to me, obviously after this review. So just to move on, what's the starting point? I always advise anybody, and I mean anybody, to do a financial budgeter at least once a year. It doesn't matter what stage you're at, it doesn't matter what your wealth is at this point. The reason being is that it's a really useful way of just getting a check on what you're earning and what you're spending. And in that, there's a really simple tool. It's available on our website. We can provide you details of this. It's an Excel sheet, and it's something that I've religiously done every year. What are you earning versus what you spend? Now, some of you may keep a fairly reasonable eye on this, and it shouldn't take very long. Typically, I say about 15 minutes with your online banking app open. And for those of you that actually have, and you're looking at this on an iPad or a laptop or a PC, you can actually use the QR code that's on that phone that you can see it on the screen to actually go into the budgeter directly. But again, it is available on our website and easy to access. The purpose of this really is just to see where you are spending your money and where there might be leakage. Where can we help? Well, we help people in reducing the cost of things like your insurances. So specifically, things like anyone who has a mortgage would have been forced to take out mortgage protection. A lot of you would have been forced to take out policies more expensive than I believe that you need. And this is where it's really worthwhile checking in with somebody independent. The same for things like car, house, and health insurance. These are large costs for a lot of us that I don't think necessarily always best managed. I was talking to someone earlier today who said that they shopped around for their car insurance, and by virtue of giving them details of one or two brokers, we could see that there was definitely quite significant cost savings for a like-for-like plan. So again, the key takeaway from this is it would be really useful to do a budgeter. And what I'm looking to do really is find out what excess someone has. So you can see here, there's a couple I met recently earning a good net monthly income between them. It's about just over 6,500. Their total monthly expenditures were adding up to about 5,300. So officially it was showing that there was a cash surplus of about 1,200 euros a month, but it wasn't presented itself in reality. They just didn't see this money in their account. And it was because there was a number of things that they were spending money on that they just didn't realize and that they hadn't allocated for. And in helping them, we could get back to that position of that 1,200. And then it's a case of how do they allocate that into those three different pots that I spoke about earlier, the short, medium, and long term, and then just ensuring that we balance those out. One of the biggest things I say to individuals is, particularly if you're getting bonuses or indeed pay rises. So this tends to be around this time of year that I find some clients are getting a bonus. They may be due a pay rise perhaps later in the year or early into New Year. And if you're not used to it, it's easier to allocate. And I talk about a philosophy of spend first, um, sorry, save first, I should say, and spend later. And what I mean by that is that there's no point saving what you have left over at the end of the month. Unfortunately, what happens is a lot of times you get to the end of the month and you have nothing left. My key principle is if you are saving for something, save what you want to save or believe that you should be saving, and then whatever's left over, you can basically spend. So, for example, let's say if you have a goal of saving 10,000 over the next 2 years, because that's a committed expenditure that you have to take. Simple math will tell you that you need to save about 417 euros a month for that 2 year period. Where should you save? Well, again, back to what I said earlier, typically the short term accounts for the bank, credit union, post office. I would certainly recommend looking at AIB, Bank of Ireland, and ESB for that matter. The reason being is that they are providing much better returns now. They're paying rates of up to 3% for savings over a maximum of 12 months. But just be mindful that the devil is in the details. So you have to stay within the restrictions of the limits, and that if you do save for over 12 months, those rates do fall quite considerably. So just to stay within the parameters, we can send you a table of all the rates through the banks and different terms and conditions. Again, there's no obligation to take the advice that we give you. Looking at medium term, this is this kind of 3 year plus, I suppose, cohort. And there are accounts, and we set up the Alpha Savings and Investment Club about 12 months ago, which has proven to be very popular. What it does is it allows people the opportunity to save money every month. You can add a lump sum into this. Works extremely well for children's or grandchildren's savings, and you can do it in a more tax effective manner for your children, whereby there's no entry fee to go into these accounts. There's no exit penalty at any time. You can vary them. They're completely flexible, and they're typically earning interest of between 4 and 6% per year, which is much more favorable than the banks, obviously. And the key focus that I say to anybody, particularly over that medium term, is inflation, which has been stubbornly hard to get down. And we know the story with the ECB trying to use interest rates, obviously, which they've hiked up to reduce inflation. But it's going to be more likely around 3% a year over the medium to long term. So therefore, it means that if you're not earning 3%, you're losing money. So people who have money in the bank, unfortunately for them, that money's been eroded. And the key principle that I say to them is that you really need to try and get at least 3% a year. And I do believe that these accounts will provide that. And if anyone would like some more information, again, please do reach out to us and we can provide that to you. Just in relation to long term, and again, I can give you more specific information about your own situation, whether you have a company pension scheme, whether you have a pension scheme from a previous employment. And one of the key aspects for anyone who is in that position is we explain to people how you can access that pension effectively, very tax efficiently from the age of 50. Some people I come across seem to have an issue with having more than one pension. And I say to them, it shouldn't be a problem as long as it's properly managed. And again, we can give you independent guidance around how you can make sure that you're getting the most from that. But more importantly, understanding the rules that are applicable. Anyone who's listened to this call, who's working for a company that doesn't have a pension scheme in place, there is, I suppose, a provision from the government where they are going to introduce pensions as a mandatory scheme before the 1st of July 2024, i.e. within the next 6 months. And it's important just to know what that might look like and obviously put you in a position on the front foot where you can understand the options within that, obviously to get the best for yourself. The table that you can see on the screen shows that we've all got really, really large capacity to pay money into our pensions. So for any employees listening to this, if you're like me in your 40s, you can put up to 25% of what you earn into a pension. So let's say you're earning 50,000 euros a year. That's 12,500. Now that may seem like a large sum of money to some of you, but if you break it down monthly, that's 1,000, just over 1,000 a month. But the government will give you back 40% of that at source. So effectively 400 euros is deducted from that figure. And the key aspect of a pension is that it grows tax-free for the duration of when the money sits in your pension account. And it's really important to know where your pension is being invested. Some clients I speak to, they in totally inappropriate accounts, depending on their age and their time frame. The rule of thumb is that the longer that you're saving into something for, the more risk you should accept, particularly when it comes to pension funds, to get that tax-free growth. Anyone who has a business or indeed is self-employed, the limits are much more generous, and I would suggest that it's worth getting advice and seeing how you can make sure that you're taking advantage of opportunities. If you're like me as a business owner, there is no restriction to how much money you can pay into your pension. The rules changed earlier this year, have made it much simpler, and there's no drama with pensions. The only issue I have with them is that they're made complicated by the press and by other financial advisors. So just to get into the nub of this, and please again, for anyone who came onto this webinar late, please do feel free to pop any questions into the Q&A. We will endeavour to answer them, and I just want to make this as interactive as possible. But I'll start by going through a couple of case studies. So again, this is a client that I came across back in February, earning about 40,000 a year, 30 years of age, and was basically looking to get onto the property ladder. They didn't want to work beyond 60, and they had a car loan, which, whilst in itself isn't a massive issue, the point I make to people who have loans, and this is something that we do help our clients with, is how to get rid of these loans. And basically, the rule I use is something called snowballing. You start with the smallest loan first, work on paying it off as quickly as possible, then you get onto the next loan and so on. Typically, you exclude your mortgage. The reason being is that it tends to be the lowest cost of debt that you have, even though I think it's really important to know how to navigate your mortgage, particularly with the recent rate rises that we've seen. For those of you, I'm sorry now, and I appreciate there's a question that came through, and I will, my colleague Cleaner will address that towards the end. So thank you for the question, and please do feel free to keep asking them. So for this particular client, Mary, basically using that financial budgeter, we were able to get into a situation where she was able to save about €1,000 a month whilst clearing off the car loan. And essentially what that enabled her to do was that she put the money split between AIB, which was a short-term account, 12 months, getting 2% for her. It's very simple. She was with AIB. It's an online saver she could do behind the desk. And then the Zurich account that I've made reference to, we work with all of the insurance companies. Zurich would be the best of that type of provider, and we offer them the lowest fee possible with no entry costs, and earning about 5% per annum. And over the course of the next 3 to 5 years was going to give her an ability to get to a deposit of between sort of 30 to 40,000 a year. What the plan was for Mary then is to basically ensure that she had no loans when she approached the mortgage broker, and we gave her the details of someone just to get some kind of early advice to basically present herself within a year of looking to get a mortgage. And I would suggest for anyone who is looking to buy a property, it's really important to speak to an independent mortgage broker. We're not affiliated to anybody, but we do give advice, and I suppose to people, to help them get the best mortgage possible. The reason is that anyone who banks with AIB and takes their mortgage out with AIB is not necessarily getting the breadth of the market of the other providers. And because of the recent rate rises, it's really important to make sure that you're jostling between the best bank for you. I'd advised her to increase her pension contribution. The reason being is that she could afford to do that. It wasn't going to impact on her ability to save for her mortgage. She was saving more than enough between the rent she was paying and that €1,000 a month. And the point being is that it was going to enable her to build up that pension, particularly before she incurred any further costs. The point is, we all go through different stages of our financial cycle, and it's about being able to, I suppose, deal with the situation at hand. And whilst Mary was in a position to fund her pension, I told her she should do it. And if her situation changed, of course, you make adjustment. But the key thing was, again, back to this sort of balancing of the different parts, making sure that you're making provisions, especially in the more tax efficient areas. This couple that I met, they were slightly older, in their early 40s, had a mortgage taken out. They had 3 kids, and basically their main aims were to try and ensure that they could get enough money together for when their kids were going to require monies for 3rd level education. Now, this is not everything that we did for them, but just to put, I suppose, some kind of broad context to this, the simplest things that we did, and these were really powerful and they didn't take much time or effort, is that I asked them to contact their own bank, which happened to be AIB, and that whilst they have 12 months left on a reasonable fixed rate, that they could fix for a green rate, which is what they did. They had a reasonable BR rating of B3, which qualified at 3.75%. And that was going to save them about 120 euros a month on the 5% rate that they were going to get in about 12 months from now, if not higher. The other point was that we were able to reduce the cost of their health insurance. Again, we don't provide health insurance in Alpha Wealth, but we save clients money specifically by explaining to them about what they wanted from their health insurance policy. They were overinsured, getting online discounts, excuse me, and also making sure that they were availing of kids offers. I have 4 children and I've only ever paid for one child when it comes to health insurance by availing of the offers that companies provide. And certainly for any people that listening on this call who have more than one child, it's something you should consider. And even if you have health insurance through your employment, it's not a free benefit. You pay benefit in kind. So it means that you're basically paying the cost of the plan. And therefore, what you should do is make sure that you're making sure you're on the right plan for you. So if they have a gold, silver, bronze plan, make sure that you're not just picking the best plan possible because you think it's free. What the savings that we were able to get them for, including mortgage protection savings, which anyone paying over 25 euros a month for, I certainly recommend that you should talk to us and we can show you how you can save money. But we were able to set up these savings plans where we allocated savings for their kids in a very tax efficient manner, where they could see very specifically on an Excel sheet that we provide all clients how much money they would accumulate for each of their children as they required. And certainly for children of those ages, even from a standing start, I would say that you'd be more than sufficiently covered, in my opinion, for what you would need. Finally, this is a client I met only a couple of weeks ago who was essentially coming towards a time of which he wanted to work for another 5 years. And essentially, whilst he had a pension and was paying a reasonably decent amount into his pension scheme, he wasn't paying as much as he thought he could. The reason is that those limits I showed you earlier, they didn't allow for the fact that they don't include the employer's contribution where he was deducting that. So for somebody in their late 50s, you can put up to 35% of your earnings. So it was a very simple adjustment. He could afford to do it because he was getting a 40% rebate on his contribution. It was obviously working out very effective for him. And he was able to save a total of 700 euros a month in tax on a gross contribution of 1750. He had put his fund into low risk. It was too low. I explained to him that what happens at retirement is you only draw a quarter of your fund. So we adjusted that, and now he's on a trajectory to make more money than he was going to. And the projection that I showed him basically was going to bring him from a fund of about 300,000 in today's money to about 450,000. And that brings me to that point I made earlier. Why is that enough money? Well, it gives you about 100 to 112,000, between 400 and 450 of a pot, tax free, and then about 25 to 27,000 a year of an income. Now, depending on how much you're earning, that might be a big drop. But if you take into account the state pension, which most of us will be entitled to, albeit that it kicks in currently at 66, that brings you to that threshold where you don't pay tax at the higher rate of 40,000 a year. Now, again, I can explain to you why I think it's suitable. If you've paid off debt, if you've got that tax-free sum sitting in the bank that you can use to supplement your earnings, there's no point having a massive pension and paying a lot of tax. It's about making sure that you're making enough of what you have. On top of that, we had suggested that he invested some of the money he had sitting in the bank. There's a tax scheme, which again, we can provide more information on, and I will be talking about it more in a follow-on webinar, where you can invest money into one of the qualifying companies in Ireland. It's about 50 or so each year that look for finance, and you get a 40% rebate, i.e. 8,000 euros in an example that I'm using there on the screen of 20. And after a period of 5 years, you get your money back plus interest. It's a really good scheme for anyone who does pay tax at the high rate, particularly if you are paying a lot of tax at the high rate. So just lastly, before I kind of move into the questions, one of the other things that we help our clients with is understanding the revenue online system and being able to use it. It allows you to go back 4 years. I strongly encourage anyone who hasn't used it to make sure that they are taking advantage of tax refunds that you're due. And revenue are very good to deal with. We can help you in terms of understanding what you can claim for. Anyone, for example, who's renting, if you're in a relationship with someone who's renting with you, you can avail of €1,000 a year for last year and this year. There's €2,000, and a lot of people haven't claimed for that, which I find it hard to believe. But on top of that, for anyone who worked at home during those COVID years, you can make a claim for expenses that you incurred. And again, like that, it's really, really simple, and we can help you navigate that without any drama. So just briefly, before I get onto the questions, just a quick summary on the areas that we help our clients with. Reducing the cost of your mortgage, really simple. I'd strongly encourage anyone who's on a fixed rate, tracker rate, or variable rate to talk to us. We can help you understand about what you can do. And it's not a case of like doing nothing, particularly if you're on a fixed rate that's coming up to expiry in the next 12 to 24 months. I mentioned mortgage protection earlier. House insurance and car insurance falls under that banner, as does obviously any old pension schemes. And particularly if you have a savings plan, and some people say to me, Nick, I've got a savings plan already with the likes of Irish Life or Aviva or indeed Zurich. And I say to them, well, okay, but do you know what costs you're suffering? Because if you're paying a fee of something like 5-6%, it's going to erode any returns that you're going to make. So it's really worthwhile talking to an independent broker like Alpha Wealth to make sure that you have the right plan at the lowest cost possible. So I'll bring my colleague Cleaner into this and I'll take some questions. Thank you.
Okay, and thanks to everybody that had sent in questions, and feel free to put any more in that you feel you'd like to ask. So the first one, Nick, is around pensions. Pension annuities appear to be fairly dismal. I can get 25% of pension in a tax-free lump sum. Would I be better off getting the other 75% as taxed lump sum too? And what rate is the tax, please?
So was it correct to say that you're entitled to 25% of your pension tax-free? The 75% normally wouldn't be provided in what's called an annuity. Now, not to, I suppose, create too much jargon, but that means you get a kind of a fixed figure for the rest of your life. Annuities have been phased out. Typically, the way it works is, and I'm going to use the phrase fund, the 75% goes into a fund. So the example I gave earlier, 400,000, you get a quarter tax-free, 100,000. The 300,000 goes into a fund, and you draw it as income. So the time to take your pension benefits are when your income falls. And what you're looking to do is to take enough income that you don't pay tax at the higher rate. Taking the 75% of a tax lump sum would be madness, because you're going to pay a significant amount at the 52% higher tax level. So again, I'm happy to give you some advice, but I certainly wouldn't be looking to draw down all of your pension and pay tax on it. It would be crazy to do that.
There was a third part to that question as well, and it just said, overall pension return is 2%. Is there anything I can do to improve it? This person is 50 years now and contributing to the pension about 15 years.
Certainly, like a pension return of 2% is ridiculously low. And I would like to suggest that, again, if we got a little bit more information in terms of which provider you're with, which funds you're invested with, whether it's through a company or whether it's obviously a personal pension, but I certainly would be looking for returns in excess of 5% a year for the time frame that you've described. So certainly there seems to be an issue there.
The next question is referring back to the slide you put up around deposit rates. So it just says, I'm interested why €500 would be put to AIB at 2% rather than the entire 1,000 to Zurich at 5%.
That's a really good question, and I appreciate you picking up the point. The reason why we split the savings for that particular individual is their savings horizon was 3 to 5 years. And I suppose it goes back to what I was saying earlier about this short, medium, and long term. If Mary, and again, I did alter her name, but if she was saving for 3 years for a mortgage, it would be more prudent to have that kind of hedge of both the secure AIB account, but then obviously the blended approach of the Zurich account. The Zurich account does carry an element of risk, not high risk, and you can't there's no free lunch out there, as we know, but that was in that instance. Whereas if Mary's time horizon was 5 years, you're correct in your point. It would have all have gone into that Zurich account because it would have allowed her the ability to kind of have the growth over that period. And if there was a poor period, albeit the maximum loss in that account was 5% also, it would be prudent. So basically, it was just a case of like getting the best of both worlds in her particular instance, but it's because the time frame might have been shorter than the norm, which I would say typically for Zurich would be 4 to 5 years and beyond.
So the question is coming in here around pensions, and this person is using the Mercer projection tool, which is telling them that they have 600k in their pension pot, and they'd only get 66k as a lump sum at 65. And what they've said is that it's very different to the projection that you've given. Any particular reason for that, I suppose?
Yeah, so firstly, the different assumptions are being made on these projection calculators. And again, I would suggest that I can explain to you what we use. So for example, we quote for growth at 6% a year. We suggest inflation over the longer medium term would be 3% a year, which I both think are very valid assumptions to make. The Mercer tool that you're using, and it depends on the type of pension you may have, it looks to me that that lump sum that you referred to is not accurate on the basis that you are entitled absolutely to at least 25% of your pension fund. Now, those figures obviously don't add up, but I'm happy to speak to you perhaps in a little bit more detail and give you some guidance on that. One thing I should have mentioned, and I suppose just in terms of anyone who is interested in kind of getting a little bit more information, I'm happy to take, as any of my colleagues are, any queries that you might have, and we'll answer them. There's no obligation to take our advice. There's no cost of questions you might have, but we do offer a 1-hour consultation, which costs typically 199 euros. We are discounting that for anyone who does listen into these webinars, and we have the discount code there on the screen, Alpha 50, where you can apply obviously through our website. There's a link, which again, my colleague Ruth might put into the chat. It's very simple. You can get access to it through our website, and it will go through basically a review with myself or my colleague David Looney, who's a senior financial advisor, all areas of your financial planning, where you are currently, what your financial goals are, showing you your pension projections, showing you how you can save money and reduce tax, getting your money working harder for you. It's a really good, and again, you might argue I'm a bit biased, but I suggest that we really do rate ourselves in being very good at what we do. The fact that we operate as independent brokers, and the fact that, you know, I suppose you're dealing with kind of business owners that are vested in our business, is providing that kind of long-term relationship, which is what we want to try and achieve. But again, as I said, if anyone has any specific queries, and particularly in relation to that question on the Mercer pension, if you can share some information with us, I'm more than happy to explain them to you. But I think there's something that is not being fully disclosed. Well, it's not being provided through the Mercer tool, which is maybe throwing out those numbers.
Nick, we have 2 more questions. Are you happy to take them?
Yeah, absolutely. Please feel free. I'm happy to continue if people
So
are.
if you have 2 pensions, can you take the 25% of only one initially and postpone the 25% of the second pension to a future date? Or has your retirement age a part to play on when you draw the 25%?
Thank you again for the question, Gus. You can take 25% of the totality of your pensions, and you can take them typically at different times, as long as they relate to 2 different employments. So for example, if you have you know, 2 pensions from the same company, they have to be drawn at the same time. But pension rules have changed and have been simplified since the 1st of January this year. And in that instance, I suppose basically my reading of it is that you can take those 2 pensions at 2 different times, and you can take the 25% of each at 2 different times also. There's much more flexibility, and it's absolutely, and it has no bearing on your retirement age. Your retirement age, by the way, is when you want it to be. A lot of people can access pensions from 50. For most people who are employed in a company, it's basically the age at which you finish up employment with them. But don't be bogged down by 65 or 66, which is the state pension age. Those dates are only notional.
Raisin Blue, our bank, it says offer 4.21% for 12-month months lump sum covered bank deposit guarantee scheme. Can you just give your views on that,
Yeah,
please?
that's interesting. So Raisin, just to explain to anyone who's not familiar with them, they're a European institution that basically look for best rates within different countries. The 4.21% for 12 months is valid, and yes, it is covered by a guarantee scheme, but it's not an Irish guarantee scheme. And you just have to be mindful of which country. So I think that particular offer was for a Latvian bank. And there are different banks providing different rates. So like there's a Portuguese bank, BBV, who are offering, I think, 3.6, and then so on and so forth. I suppose, look, it depends on how much you have, and it depends on your comfort around obviously investing in a non-Irish bank. The point I'd make, though, is that you can get 3% now with Bank of Ireland for 12-month money. And personally, I'm not sure if there's enough of a differential to warrant moving money into those foreign banks. But if you've got a lot of money, then maybe it's a case of diversifying. And on that basis, I wouldn't have a massive issue with that. But just to note that there is a slight nuance. It's not obviously through obviously an Irish institution.
So is there a webinar planned soon around the EIIS scheme, or should I reach out individually? And I suppose just to explain, this is a tax incentive scheme for anybody that's not familiar with it. Curious if the list or top selections from the list has changed since the last time you ran webinars on this topic.
Again, Owen, thank you for the question. So firstly, we're happy to share with you details of the qualifying companies in the top 3. The list has changed slightly. In relation to webinars, yes. And again, I think my colleague Ruth put up the link for the upcoming webinars that we're doing. My colleague David will be talking about them next Tuesday. I would encourage you to at least get access to the videos and the webinars so you can listen back to them at your own leisure. I'll be doing one specifically on EAAS on the 21st of September. But again, it's important for you to maybe get specific information as and when it suits you. So please do get on to me directly and I can provide information directly to you.
I think that's all the questions. So I will hand it over to you, Nick, to wrap it up.
Great. Thank you very much, guys. I really do appreciate your engagement today, and thanks for all the questions. As I said, we're always interested in getting feedback, so please do feel free to send us a reply. The slides and the webinar video will be made available, and if anyone would like them, please just drop me a line and we'll do that. And for anyone who has attended live today, we will send you the slides just to peruse at your own time. There are a few different things, and I suppose the biggest thing to look out for is that we are coming towards the tax deadline of October 31st. It gives you an opportunity to get tax back for last year. And if anyone would like some more information about how to do that, please do just drop us a line. My email address is really simple, just nick@alphawealth.ie. Thanks very much again for your engagement, and I do appreciate that. I will keep the Zoom open, and if anyone would like to just pop me a quick question through the chat, even anonymously, I'm more than happy to stay on and to take questions. So thank you very much again, guys, and enjoy the rest of the day. Thanks.